Thank you everyone for joining us today. We have planned a relatively interesting session today on Gift City. It's a relatively unknown segment, and many people in the industry are talking about it, but it's not very well understood by the investors. And we have with us Mr. Pankit Shah. He is Director of Client Relations at Arga Investment Management. Arga is a global asset management company. Mr. Pankit leads the effort for fundraise for Arga Investment Managers for India, Middle East, and Thailand. He has over 17 years of experience in products, business strategy, sales, and distribution. Prior to joining Arga, Pankit has played leadership roles across domestic and international business at White Oak Capital and Motilal Oswal AMC. He has also worked with Axis Bank, where he was heading the alternate product segment. Thank you so much, Pankit, for joining us today.
Thanks, Aditya. It's a pleasure being here. And thanks a lot to all the guys who are joining in. It's always a pleasure to speak to everyone.
So I'll start with a very basic question on what is Gift City and how it helps Indians invest outside and foreign nationals invest in India.
Great question, Aditya. So see, Gift City was established with the purpose of attracting foreign capital to come into India, right? So it's nothing but India's designated offshore zone for foreign investments, right? So typically, if any large foreign client wanted to take exposure to Indian markets, they found it very tough because think of it like this: Indian asset managers only accept money in local currency, right? Foreign investors typically want to invest in foreign currency, but there was a gap. If a foreign investor wanted to invest in foreign currency, local managers would not accept foreign currency. There had to be a zone which could accept investments from foreign investors in foreign currency. Right? So worldwide, there is always a financial hub. Gift City is nothing but a financial hub, which is offshoring of domestic operations. So today, if foreign clients want to invest in India, they can directly transfer money from their foreign currency account into Gift City, which accepts money in foreign currency. The manager in Gift City can then convert that to INR and invest in Indian markets, right? The same license can also be used to do the reverse. Today, if Indian clients want to take global exposure, right, they can actually invest in a Gift City fund, which aggregates money from Indian clients in foreign currency. Whatever money the manager aggregates, they can allocate to global managers like ourselves, right? So, to my mind, Gift City solves for two purposes. It helps foreign clients to invest in India in foreign currency, and it also helps Indian clients to invest abroad in foreign currency. In fact, there is a third element to it, right? If NRI clients, foreign nationals, want to use Gift City to take access to global markets, right? That's also a huge opportunity. So I think these three segments are the biggest beneficiaries of Gift City.
Right, and it also solves a lot of operational issues.
Yes.
And my personal take, it could revolutionize Indian markets and would open the entire world for us.
Absolutely. So see, think of it like this. You go to Dubai, you have the IFC, right, which is nothing but a jurisdiction for enabling local, Middle East clients to take global exposure, right? Same is the case with India. See, up till now, whenever Indian asset managers wanted to tap foreign capital, they set up offshore funds outside of India. You always had Cayman structures, Mauritius funds. In fact, the biggest example is, up till 2-3 years back, if foreign clients wanted to access Indian markets, they would go and trade on Singapore Nifty, right?
Correct.
So, what was happening up till now? If there was a foreign client who wanted to take exposure to India, revenues were actually booked outside of India, right? If you had a Cayman structure, if you had a Mauritius fund, revenues were booked outside of India. Employment opportunities were generated outside of India. Tax incidents happened outside of India. So when Mr. Modi went and visited some of these offshore locations, he said that, why can't we bring all of these practices to India?
Correct.
That gave birth, in my view, to Gift City. So now, whatever fund structures were available outside of India, Mauritius funds, Cayman funds, you can actually bring all of those to Gift City. The same regulations apply. that applied to foreign fund structures. So therefore, GIFT City becomes a great medium or a great a place to attract foreign capital which wants to participate in Indian equities.
Right. And you are with a global asset manager, Arga Investment Managers, and you're running an emerging market fund along with Aditya Birla AMC.
Right.
So, can you tell us more about Arga Investment Managers and your relationship with Aditya Birla on this particular product?
Definitely. So, see, Arga is a pure play global asset management company, right? So, we only do one thing, which is asset management. And within asset management, also, our focus is only on global listed equities. So, we run our own US equity fund, emerging market fund, European equity funds, etc. All put together, we manage about $19 billion of assets under management. Call it 1,60,000 crores. Right? What is surprising is that this entire $19 billion comes across only 144 clients in the world. So you'll appreciate we are pure play institutional managers. Right? If I'm managing $19 billion, we only have 144 clients. Average ticket size per client is about $150 million. So who are our clients? Our typical client segment would be sovereign wealth funds, endowments, pension funds, or large asset management companies who do sub-advisory with us or who do fund of funds with us. So when I was entrusted with with the job of raising assets from Indian clients, Southeast Asian clients, Middle East clients, we thought the best way to tap this market was to tie up with an asset management company in India and get that asset manager to do a fund of fund on us. Now, Aditya Birla, which is amidst the top 5-6 asset managers in the country, they have launched India's first dollar-denominated fund of fund. It's India's first outbound GIFT City fund, right? In simple terms, they will aggregate money from Indian clients, NRI clients, foreign nationals in their fund in foreign currency. Whatever money they collect in their fund, they will simply pool it and invest in Arga Emerging Market Fund, which is a Dublin domicile UCITS fund. So, to my mind, for us to tap the Indian market, we just have one institutional client, which is Aditya Birla, right? And Aditya Birla, in turn, will use their brand, their distribution reach, their local ability to understand this market and attract clients in their fund, who will in turn get access to emerging markets through Arga. So that's the way we have structured this fund, Aditya. To my mind, it is the best way for Indian clients to take global exposure. And it's also a great tool for, HNI clients, NRI clients residing outside of India to get access to an institutional manager like Arga, who typically manages money only for sovereign wealth funds, endowments, pension funds, etc.
Right. And this is a emerging market fund. You're a global fund manager. How are you currently looking at the valuations in different emerging markets? And which are the geographies where you are currently underweight and overweight on? I remember looking at this particular product 3 months back, and I saw overweight on China.
Yeah.
And that's why I also personally started looking in China.
Yes.
So can you tell us more about the valuations and the geographies where you are overweight and underweight?
So Aditya, Arga is a pure play classic value manager, right? That means we only do one thing. We do valuation based investing. Typically, we are always on the lookout of investing in good quality companies across emerging markets, which we believe are available cheap because of temporary issues. Now, you'll appreciate that if a good quality company is trading cheap because of a permanent problem, then it's a value trap. But think of it like this: if a good quality company is trading cheap because of a temporary issue, then it could be an investment opportunity, right? What are these temporary issues? Temporary issues could be anything. It could be sectoral headwinds. It could be geography-specific issues. Or it could be company-specific issues. Our job as investment managers is to cherry-pick good quality companies that we believe are available cheap because of temporary stress. Now, what happens typically is, because, humans invest in companies, there is a large emotional bias that is attached to any company that is undergoing stress. Right? So our job is to capitalize on this human emotional bias, because of which the stock price has been beaten down, and we want to buy these good quality companies to build portfolios for our clients. Now, if you are a classic value manager and you are constantly on the lookout of buying good quality companies which are available cheap, right? Then definitely there will be a bias towards geographies that are trading very cheap today, right? So you're right. We've been overweight China for almost a year and a half now, right? To my mind, it has played out well. We've already seen Chinese markets move up dramatically over the last 3-6 months, right? And that, that that has to do with the sentiments that are undergoing a change, because government officials in China have come out and said that we'll do whatever it takes to save the financial markets. We'll do whatever it takes to revive the economy, and I think that has led to some change in the sentiments. For us, typically, uh, if you look at the breakup of the entire emerging market index, right, there are about 24 geographies covered under MSCI Emerging Market Index. At Arga, we have licenses to go and buy stocks across all of these 24 geographies. 7 or 8 of them would be very, very small markets. We call them the frontier markets, right? They are hardly, investable, likes of Peru, Cuba, Pakistan, etc. Right? Very, very limited investment opportunities. Our job as investment managers is to cherry pick 50 to 60 stock portfolio out of these 15 large emerging markets. Now, which are these large emerging markets? If you look at the MSCI Emerging Market Index breakup, some of the larger emerging markets includes the likes of China, India, Taiwan, Korea, Brazil, Africa, some parts of Eastern Europe like Hungary, Poland, some Middle East countries, and in fact even geographies like Africa, Thailand, etc. Right? So we typically want to go and buy good quality stocks across these geographies that we believe are available cheap today. Now, how do you define what stock is cheap? At Arga, we have a very simple, see, to my mind, if you really want to do emerging market investments and you want to really create wealth for clients, you need to have two things which are very, very essential. One, a very deep bench of strong seasoned professionals who have looked at emerging markets in the past, right? And second, a very well defined investment process that keeps the emotions away from investing. When these two things combine, right, strong investment team talent along with a very well defined investment process, that's when you can really capitalize and play out the disproportionate valuations that exist within these stocks. So if you actually look at our investment process, our process tells us when to buy and when to sell. The job of the investment team is to do very deep research on these companies and understand why these businesses are trading cheap. Companies that we believe are trading cheap today, because of temporary issues, become investment opportunities for us. So if you look at it today, we are invested across 57 names, spread across 10 to 15 geographies. Right? Clearly, given where valuations are, our overweight positions lie on markets like China and Brazil. Right? Brazil is coming out of a decadal bear cycle post 2010. Brazilian markets were trading very, very cheap, right? Because overall consumption slowed down after the global financial crisis in 2008-9, and then there was a final blow, which was hit because of COVID. Because Brazilian geography was coming out of a tough commodity cycle, valuations of some of the companies which are available in Brazil were trading very cheap. So, we went and we were overweight Brazil in the years 2021, 22, 23. I think it has worked out very well because Brazil was probably the best performing emerging market in 2023. Bovespa index was up approximately 33%. At similar time, Indian markets were up 18%. Last 1.5 year, 2 years, we've been overweight China, right? Because again, China is a classical example of geography-related stress, right? Foreign institutional investors, clients, they don't want to look at China because they believe that there could be US-China trade wars, there could be fears of the Chinese economic slowing down, which is actually happening, or there could be fears of China attacking Taiwan, right? So because of this geography-related stress, what happens? Typically, institutional investors become sellers in that market, right? If you are bearish at geography, you don't go to the geography and sell stocks. You just go to the geography and sell the entire index, right?
Correct.
So that is exactly what was happening with China. And when institutional investors turn negative at geography, good, bad, ugly, all companies collapse.
Correct.
Our job as investment managers was to cherry pick good quality businesses in China, which we believed were available cheap because of this temporary sell-off. So we've been overweight China for the last 1.5 to 2 years. I think it has played out really well. Some of the names that we own in our portfolio are up almost 40 to 60% in this year itself, right? The entire Chinese market is up almost 25% in the last 2 months. So, that's what we do, right? Today we find Brazilian markets attractive. Today we find Chinese markets attractive. So we are overweight China, Brazil. We are underweight markets like India, Korea, Taiwan, because these markets, are classic, strong fundamental stories. But valuations in these markets are not attractive, right? Today,
Right.
we all will agree that valuations, in India may be expensive. Valuations in geographies like Taiwan may be expensive, right? Because they are large semiconductor markets. But fundamentals for these markets look very, very good. The problem is that classic value managers like us, we can't find too many opportunities of investing in good quality companies which are available cheap in these markets. So therefore, we are overweight markets like Brazil. We are overweight markets like Brazil, China, Africa. We are underweight markets like India, Korea, Taiwan, etc.
And what is your India exposure since you are underweight over here? And does it make sense for Indian investors who are particularly where portfolios are aligned towards Indian markets to diversify their portfolios in emerging markets except India?
Yeah, I think see today, because India is a partially capital regulated economy, right? You look at any Indian client's portfolio, 95% to 100% of their equity investment will either be Indian equities or US equities at best, right? So when you add an emerging market fund to the portfolio of a client which is skewed towards India or US, suddenly what happens? The portfolio risk comes down dramatically because the client is diversifying across 10 to 15 other geographies. He's de-risking away from India and US, right? So that's the first point, right? Emerging market funds provide great diversification benefits to Indian clients. Second, in my view, today when Indian clients want to look at investments beyond India, right? What are they necessarily looking at? They are looking at investing in geographies which are available cheap today, right? Because India is a growth market. So, and most managers in India are growth managers, right? So when you invest with an emerging market manager which practices value style of investing, you are not only doing geographical diversification, you are also doing style diversification, right? Now, Aditya, I'm sure you would have looked at a lot of managers in India, and then over the last 2-3 years, most managers in India would have struggled to outperform the index. The reason being that growth as a style was not really playing out, between 22 to 23, right? Now, growth is back in favor, but otherwise it was largely value style. Most of your clients' portfolio would have also seen benchmark-like or maybe below benchmark-like performance, right? The moment you add a value manager, right? Over the last 3 years for us, we've outperformed the index by almost 11% per annum. Over the last 5 years, we've outperformed the index 8% per annum. That is because value as a style has done really well. So for us, if clients in India take exposure to Arga, they are not only getting geographical diversification, they are also getting style diversification. That's point number one. Point number two, think of it like this: if Indian investors want to invest, and I'm not talking of global investments, you can put yourself and think that, if you wanted to invest, what would be 4 or 5 considerations that would go into your mind? First, you would want to invest in markets which have the ability to generate great returns, right? We all invest with the purpose of making money. So that's the first objective. Second objective is, after doing the investments, we want our portfolio risk to reduce, not increase, right? Third objective is we want to do investments in a tax evasion manner. We want to do investments in a cost-effective manner. And lastly, we don't want too many operational hindrances while doing investments. To my mind, Give City provides Indian clients with actually exposure to global markets, solving for all of these problems. Now, why do I say this? See, to my mind, real wealth creation for clients happens when 3 things collide. Clients are entering markets when valuations are cheap because entry point bias has an impact on clients' future returns. Second, they are investing in markets which are fundamentally strong because stronger the fundamentals of the market, higher are the chances of that markets delivering greater returns. And third, they are investing in the market which has potential to attract large capital flows. So when these three things combine, cheap valuations, strong fundamentals, and possibility of large capital flows chasing that market, that's when real wealth creation happens. Today, in my view, emerging markets are at the cusp where valuations are extremely cheap. You can look back at history. MSCI Emerging Market Index today is trading at 1120. Right? To my mind, over the last 35 years, you've never seen emerging markets trade cheaper than this. So clearly, valuations are extremely cheap in emerging markets. Fundamentals for emerging market for the next 5, 10, 15 years look very, very strong. If you just look at the breakup of the emerging market index, 20% of emerging market index weightage is to India. I think all of us will agree that fundamentally for the next 5, 10, 15 years, there's no market like India, right? You look at any parameter,
Correct.
corporate profitability, GDP growth rate, political stability, demographics, everything is in favor of India. We may have a difference of opinion on valuations, but I think fundamentally India looks very good.
Correct.
If we were to bet that for the next 5, 10, 15 years, globally, which sector will do well? To my mind, it will be semiconductors, right? Or AI, because semiconductors probably will be used in everything, electronic devices, EVs, etc. Where are semiconductors made? Today, semiconductors are only made in Taiwan and Korea. Both of these markets have 32% weightage in the emerging market index. So clearly, 20% India looks good, 32% Taiwan, Korean markets look good because 70-80% of their economies are driven by semiconductors. Commodity-driven markets, likes of Brazil, Latin America, Mexico, which have been out of favor between 2010 to 21, suddenly they are back in favor. So those markets also look attractive. The last market which in my view was the dark horse, which is China. Suddenly we've seen what can happen to Chinese stocks, Chinese markets, when there is a change in sentiment. So clearly valuations in emerging markets are dirt cheap. Fundamentals for emerging market for the next 5, 10, 15 years look very, very strong. Compare that to developed markets, right? US is trading at valuations last seen during the dot-com bubble. Europe is almost on the verge of recession, right? But markets are trading expensive. What will happen? Money will start moving from developed markets towards emerging markets, right? So therefore, we believe that emerging markets makes a lot of sense for investors today because valuations are cheap. Fundamentals for emerging market for the next few years look very strong. And therefore, there is a large possibility of capital moving from developed markets towards emerging markets. So to my mind, if clients were to look at investments beyond India, the most attractive option looks emerging markets. Second, as I said, because typically Indian clients have large, tilt of their portfolio to Indian equities, US equities. Adding an emerging market fund helps reduce risk. So we're talking about generating great returns for clients in India with lower portfolio risk. Third, because of the advent of GIFT City, you're doing this in a tax efficient manner, right? If Indian clients invest in a GIFT City fund, especially a category 2 EIF, there is no tax, it's a pass-through vehicle. So therefore, clients end up paying tax in India at LPCG, which is 12.5% for holding period of more than 2 years. And fourth, you're doing investments in a cost-effective manner because since this is a fund of fund, Aditya Birla being an institutional client, we offer them institutional pricing and they charge clients over and above this. Lastly, because of Aditya Birla's pooling capability, clients get access to an institutional manager like us for ticket size starting $150,000 in GIFT City. Right? So to my mind, it's actually a solution for Indian clients looking at getting geographical diversification and creating wealth by investing through emerging markets.
So you also answered my next question. I was going to ask about the structure of the product. So it's a category 2 AIF.
Yes.
And the minimum ticket size in this product is $150,000.
That's right.
Can the client invest in phases in this particular product, and what is the tenure of the fund?
So Aditya, the way the fund is structured is it is a category 2 GIFT City AIF, which means clients can invest in this AIF only in foreign currency. Does this entail you to open dollar accounts? The answer is no, right? If there are 3 segments of clients to my mind who could find this product relevant. Resident individual investors like you and me, if we want to invest in this fund, minimum ticket size is $150,000. Maximum that we are permitted to transfer from our rupee accounts to the dollar account is $250,000, which is the LRS limit, right? But if one of us has money lying outside of India, we've already used our LRS limits in the past. We have some export income. then we can directly transfer money from our foreign currency account to the
Correct.
Aditya Birla's dollar account. So that's the first segment of the client, resident individual clients. The second segment of the client, which in my view would find this quite attractive, is resident non-individuals. So let's say one of us has a company. It could be anything: private limited company, LLP, registered partnership firm, listed company, unlisted company, anything. As per the recent overseas investments rules and regulations passed in 2022, if resident non-individuals want to invest in GIFT City funds, there is no LRS limit applicable to them. So what is the limit applicable to them? They are allowed to invest up to 50% of the net worth of that entity only in GIFT City funds without any regulatory approvals. Right? This is an automated rule. So if large family office clients, HNI clients have companies or LLPs through which they do the investment, they can take meaningful exposure to global managers like us up to 50% of the net worth of that entity. So they can invest from their Indian entity in a GIFT City fund. On maturity, they get back money in their Indian entity. So that's the second category of the clients, resident non-individuals. The third category of clients, which in my view will also find this very useful, is all NRI clients, foreign nationals, right? So think of it today, if you have NRI clients sitting outside of India, they want to get access to an institutional manager like us, they can actually invest in an Aditya Birla fund, starting with ticket size of $150,000. Aditya Birla will pool money of hundreds of investors like themselves, and whatever money they collect in their fund, they'll simply invest in Arga Emerging Market Fund. These NRI clients, foreign nationals, will not be taxed anything in India or GIFT City because it's a pass-through vehicle, right? They will pay tax in their home country as per tax laws applicable there. So that's the third segment of clients which could be useful for this fund: resident individuals, resident non-individuals, and foreign nationals, NRI clients, etc. So to my mind, it's a solution for all of these three categories of investors.
And what's the tenure?
Yeah. So the way Aditya Birla has structured the fund is that it was a 4.5-year fund from the time they got the approvals. So today, there is 3.5 years residual maturity for this fund. Clients who come in today will get their money back in February, March 28, right? So it's less than 3.5 year period. There is a drawdown option which is available for clients. So clients who commit $1 million, they don't need to invest entire 1 million at one go. They can invest 50% of the drawdown amount today, and balance 50% will be called upon over the next 3 months by Aditya Birla, right? So clients can actually commit 100% but only pay 50% drawdown when they start with. This allows clients to get some kind of staggering in the fund, right? And of course, if clients want to come with the entire 100% commitment, they get participation in the fund from day one. So both options are available to the clients. They can choose what they feel best for their own portfolio.
Correct. And since it's a global fund, how many stocks do you track overall?
Yes.
What's your stock selection process, and what's the typical churn rate?
Yeah. So see, Arga wants to focus on the top 1,000 companies within the emerging market space. Now, how do we define the top 1,000 companies? It's on the basis of two parameters: average daily traded volume and market cap. So typically, we don't look at companies which are trading at less than $500 million of market cap and have average daily traded volumes of less than $10 million. So on the basis of these two parameters, we define the top 1,000 companies within the emerging market space. Now we are value managers, right? So we want to buy good quality stocks which are available cheap. Now, how do you define what is cheap? So we have quantitative tools to define cheapness. So we look at price to book, price to earnings, dividend yield, normalized dividend yield, etc. for identifying stocks which are cheap. So these 1,000 stocks, on the basis of quantitative filters, we rank them on the basis of cheapness. The most expensive companies being at the top, the cheapest companies being at the bottom. Our fishing net is the bottom 200 companies, right? Which is companies which are available very, very cheap today. So that's our starting point. Our investment universe is the cheapest 200 stocks within the top 1,000 stocks in the emerging market space. Now, these 200 stocks may be trading cheap because of temporary issues or permanent issues, right? We don't want to waste our time and energy on companies which are trading cheap because of permanent problems. So what we do is we assign a 1-week research project to our research analysts on these 200 companies which are available cheap today. During this 1-week research project, they are supposed to eliminate companies which are trading cheap because of permanent problems. right? So they are only asked 3 questions in this 1 week research project. One, why is the company trading cheap? What is the reason for this cheapness? Second, what is the path to recovery? And third, what are the ESG risks associated with these companies? Now, these 3 questions enable us to understand whether the company is trading cheap because of temporary problems or permanent problems. I'll give you an example. About 3 years back, China's largest travel portal was available very, very cheap. Right? Normally, travel portals are never available cheap because they are high cash flow generating businesses. But for the first time, China's largest travel portal was available cheap, and it appeared in the cheapest quintile. So we went and assigned the stock to the research team and asked them that please do a 1 week research project on this stock. After 1 week, they came back to us and we asked them 3 questions. Why is the stock trading cheap? The analyst came back with a very simple answer that China has adopted a zero COVID policy. Travel is restricted worldwide. And clearly, because a travel portal only deals in travel-related, businesses, they are undergoing a lot of problem. So we understood what was the problem associated. Why was the stock trading cheap? The stock was trading cheap because of travel-related restrictions. Second question was, what is the path to recovery? Is this a temporary issue or is this a permanent issue? The analyst did work and came back and said, typically, whenever travel volumes reach pre-COVID levels, that's the time stock price will recover, right? So maximum, he said, it will take 5 years for the company to revive. Base case scenario, it should take 3 years. Why? Because in December 21, vaccinations were already announced prior to that, right? Travel had started worldwide, but China was the only country which was adopting a zero COVID policy. So we knew that it was not a permanent problem. The problem was temporary in nature, right? Third question that was asked to them is, are there any ESG risks associated with this company? Are there any fundamental issues? They did work and came back and said that, no, this is probably the best company within China because they are market leaders within that segment. They are the largest travel portal. Second, it's a debt-free company. Third, even if there were no bookings for the next 3 years, 5 years, the company had enough cash flows to survive and meet its operating expenses.
Correct.
So we realized that the stock was trading cheap because of temporary problems, not because of permanent problems. Now you'll be surprised, Aditya. 80% of the companies get eliminated at this stage. More often than not, companies trade cheap because they deserve to be cheap. It's not because of issues.
Correct.
It's because of permanent issues. On the balance 20%, which is 40 companies, we do very deep research. There, the team takes 3, 4, 5 weeks or even 3 months to build industry models, to meet the management, to build our own dividend discount models, to do site visits, company visits, speak to sell-side research associates, etc. Companies that we believe are trading cheap and present a great fundamental opportunity, which is testified by our deep research. Those companies find the cut in our portfolio. So typically, we have 50 to 60 stocks in our portfolio of companies which we believe are available cheap because of temporary problems, right? Because when the temporary problem subsides, stock prices bounce back like a spring, like what we have seen in some of the semiconductor names over the last 2 years, right? 2 years back, there were headwinds within the semiconductor space. There was problems of chip shortages. There were fears of China attacking Taiwan. So these stocks had corrected dramatically. It was a classic example of sector-related stress, which was temporary in nature. When that stress subsided, stock prices moved up dramatically. Or what we've seen in China, right? Most of the Chinese names were under a lot of brunt, over the last 3, 4, 5 years because of geography-specific issues. Change in sentiments because of what government officials came out and said. We've seen, what has happened to some of these Chinese names over the last 3, 6, 9 months, right? So clearly, our job is to buy good quality names across emerging markets, which we believe are available cheap because of temporary issues. Those, in our view, are large investment opportunities for our clients.
And what's the churn rate?
So currently, if you look back, Arga Emerging Market Fund was launched on 1st July 2013. So we have an 11.5-year track record. Historically, our name turnover, or what we call the churn ratio, is close to 32%, right? When I say name turnover, it is right from the time we buy the stock till the time we exit from the stock.
Okay.
But, because we are value conscious, right? Typically, if a stock price runs up dramatically, we'll trim exposures. If the stock price corrects without a change in fundamental attributes, and we remain constructive on that stock, we'll add exposure. So our weight turnover, which is, what at what time do we move out of stocks, or we trim positions, at what time we add positions. The weight turnover is close to 40%. So our average holding period there will be 2.5 to 3 years. Churn rates, varying between 32 to 40%. So it's a highly active portfolio. Our active share today is 79%, which means there is only a 21% overlap between us and the MSCI Emerging Market Index, which is the benchmark. 79% of the portfolio is away from the index. So that's where typically the alpha generation comes from.
Thank you so much, Pankit,
Yes.
for doing this session with you and beautifully explaining about the GIFT City, about the emerging markets, the valuations, and your product.
Thanks a
It
lot.
was
Aditya.
lovely having you, and we look forward to doing more such sessions with you, your team, and Aditya Birla AMC. Thank you so much.
Thanks a lot, Aditya. Aditya, always a pleasure speaking to you.